Good day all. Today I'd like to discuss how US elections affect markets. It's often said that politics and investing don't mix, but that's not because political dynamics have no impact on financial markets. Taxing, spending, policy, regulation, these are all important variables that can affect stocks, bonds, currencies, and commodities. But politics is just one of the many forces that move asset prices. Markets have thrived and sometimes crashed under administrations of all types. Plus, the emotions intertwined with political beliefs present behavioral challenges, undermining the type of rational, cool-headed decision-making that investors demand. Then there's the fact that political forecasting is a tricky business. Predicting the market's reaction to anticipated policy ratchets up this degree of difficulty. So what are the key takeaways? We wouldn't assume that Donald Trump winning the presidential election in 2024 will cause uneasy or unusual levels of volatility in the equity market. Overall, 2016 was actually less volatile than 2015. Brexit prompted a bigger market reaction by the US equity market than the 2016 presidential elections. But the nearly forgotten flash crash of August 2015 saw a much larger one-day decline. These all pale in comparison to the gyrations of the March 2020 during the COVID pandemic. As an example, small-cap value stocks rallied after both Trump's election in 2016 and, surprisingly, Biden in 2020. Both large growth reclaimed its dominant position over the US equity market. Counterintuitively, technology ended up as the best performing equity sector under Trump, while energy stocks had done the best under Biden. When comparing US equity and bond markets' performance under the past 4 presidential administrators, we note that stocks did best under Trump and performs worst under Bush. Equity returns under Obama were also very strong, and stocks have posted solid gains under Biden. Bonds did best under George W. Bush. The broader context of these returns is crucial to examine, of course. Though the candidates in the 2024 presidential election were familiar, market behavior in 2025 will likely differ from 2016 or 2020. Circumstances have changed, and the markets have learned from the past. Election results impact on market performance historically. So research conducted by Morningstar indicates that political events such as elections can significantly influence market performance in the short term, while market fluctuations, such impacts may include rapid changes in share prices, increased volatility, or shifts in investor sentiment and trading valuations. Sudden news can lead to a surge in buying or selling activity, causing share price to spike or plummet. Additionally, these fluctuations may create opportunities for day traders, but can also induce panic amongst long-term investors, leading to rushed decisions that may not align with their overall investment strategies. Long-term market performance, however, is primarily driven by fundamentals. These factors include corporate earnings, cash flow, and valuations. Market reactions after the 2016 and 2020 elections. The equity market experienced a notable surge in the small-cap value space after the last 2 elections. However, there were different drivers in each scenario. The Trump bump refers to the significant increase in the stock market after the 2016 election, driven largely by investor optimism regarding tax cuts and deregulation. This surge reflected confidence in the 2016 administration's pro-business policies and their potential impact on the economy, and benefited sectors such as financial services, energy, and basic materials. In contrast, 2020 market rally that was fueled by the rollout of vaccines and the reopening of trade. Shares benefited from the end of the COVID lockdown. Bond yields and equity indices also showed significant movements after the 2016 and 2020 elections, reflecting the market's anticipation of impending policy change. Long-term implications of the different presidencies. So initial market reactions to elections often lack long-term consistency, with different sectors thriving under varying administration, and importantly, policies. For example, technology stocks flourished during the 2016 Trump administration, while under the Biden administration, interest in renewable energy, traditional energy stocks like oil and gas, have performed well. This highlights the complex nature of market dynamics and the varying implications of different administrative policies. So, prepping your portfolio for a Trump administration. One clear lesson from the past is that elections don't take place in a vacuum. Politics sit alongside many other variables, macro and micro, fundamental and technical, foreign and domestic. These all affect asset prices. The pandemic was a far bigger driver of markets in 2020 than elections were, for example. Another lesson is that initial reactions don't always persist. The small value rally of both 2016 and 2020 eventually faded, and large cap growth stocks resumed their dominance. Earnings and cash flow are ultimately bigger drivers of markets than politics. Finally, we shouldn't assume that market behavior of 2025 will resemble that of 2016 or 2020. The president might be the same, but the context differs. The expectations that powered the small cap value rally of 2016 won't be the same this time under Trump, especially given that US equity markets' behavior under first Trump's presidency was different. Markets know the campaign rhetoric is one thing, while actually what happens under the administration is another. For investors bracing themselves for the second Trump term in office, we underline the pivotal role of portfolio construction and asset allocation. Maintaining a diversified approach, understanding correlations between assets, and preparing for different market scenarios are all integral in any investment strategy, and stay true when gearing up for any market movements or even a new president. Thank you, and until next time, goodbye.